in part because of all the upgrades. I do want to ask you, Lee, I know that you like value as well.
I do like value. I like that pause there. Listen, since the dawn of markets, those cheap, smaller stocks, even large, cheap stocks, have always led us out of a recession. That doesn't mean you have to hate tech. I am definitely guilty, Charles, of talking about how this looks very much like .com, but it's not as extreme as it was back 20 years ago when we saw this whole thing fall apart. So I would say you don't have to be a hater of tech. What I would rather see for a healthy market going forward is see values start catching up. So what I'm doing with new cash today, if you don't want to play buy high and go higher, if you're not comfortable with growth, what we're doing for our clients is we're just buying those beat up, cheap, small value names. Heck, even banks, people think I'm crazy, but I think a couple years from now, we're going to see these were very good deals. So you don't have to necessarily think that tech has to come down 20, 30, 40% to get money invested. Plus, let's remember, our largest holding is the S&P 500. 25% are all those tech names. So I'm getting it every time I buy the S&P. So I think it's a bit overstated. But again, I'd rather buy the cheap names now.
Well, here's the thing, Lee. It's not just you, right? Let's be honest. Wall Street in general missed a whole lot of this rally this year, and they really seem to focus, now on catching up, right? Almost every day, these major Wall Street firms seem to have discovered big tech, and they're raising their prices on them. They're catching up. In fact, this morning, there were no less than 4 target increases on Microsoft. Right now, the 32 buys, 4 holds, 0 sells. And then Goldman, they went to a high on 3,800 for Amazon. Credit Suisse taking their target to Facebook to 305 from 258. And Ray, I've always told people, my philosophy on investing is you chase improvements to underlying fundamentals, which is different than chasing share price. What's happening right now? Because Wall Street seems to be getting on board at this moment.
Well, the big thing with big tech is it's cloud, it's digital, it's work from home, it's AI and automation, and that's what's driving it. These are winner-takes-all models in the age of duopolies, and these digital giants are winning. Now, for the value stocks, what I'm looking at is TSA passenger numbers, right? When that breaks 1 million per day, then that's interesting to me. I'm also looking at unemployment, right? If we're down to unemployment claims less than 1%, total unemployment down 7%, I think the cyclicals are going to do really well. And, of course, I'm also looking to see what the general sentiment is, because when we think about how much money supply and how much money's been deployed, the Dow should be at 30,000. NASDAQ should be at 12,000, given how much money is in the system, but there's still a lot of money on the sides.
Right. So what are you saying then, that if you get good news, better news on the economy, perhaps phase 3, positive phase 3 on any vaccine, some of these cyclical names like the airlines, which are, all of a sudden they're getting hammered again. The cruise ships got bad news from the U.S. government. They pushed off any purported trips. So this cyclical trade, which comes alive big every now and then, but to your point, has faded. Do you hang out in these big tech names then, Ray, before then? Or do you just, how are you going about this? Okay.
I would definitely hang out on the big tech side for now, and I'd watch the other numbers, and then jump into travel, hospitality. Banking is interesting to me, but banking is hard because the interest rates are running at about 0, so the banks are going to have a lot of pressure for some while, so it's going to be cost takeout on their end, right? But commodities look great, and gold is amazing at this moment.
Yeah, you know what? On the bank side, I'm really looking at these fintech names and these companies that are involved in payments. That seems to be the place to be in financials. I want to get back to what I was talking about. A couple of cautionary articles in a journal over the weekend, including one that compared the NASDAQ to the South Sea bubble. Folks, this was described in the famous book, Extraordinary Popular Delusions and the Madness of Crowds. If you haven't read it, please make sure you read it. That's where the tulip bubble became famous. I think it's a terribly unfair comparison. Lee, you already kind of mentioned that you were sort of negative in terms of this. My problem with this, Lee, is that I think these attacks on the individual investors, for years we bullied millennials for not being in the market. They get in the market, they don't buy what the purists like, and they bully them again. I don't like that.
I know there's so much hate when young people make money buying hot stocks. I feel that pain. Here's the problem. I'm very guilty of talking about that .com analogy, but the PEs are very different today. Number one, we don't have 1,000 Teslas out there. Say what you will about Tesla, but remember 20 years ago, Charles, it was like all the companies had gone up 1,000%. None of the tech companies really made money like the big six do now. They're cash cows. And when you look at Apple trading at under a 30 multiple, that may still be a little rich for my blood, right? That's okay. But I would caution people to say that the fact that some Robinhood traders bought Hertz when it was going through bankruptcy, that's not the same as the NASDAQ 20 years ago. I don't think young people have any concept of the crazy time that we went through 20 years ago. It's similar, but it's just not there. I think we're more likely to see the down and out catch up because the market looks 6 months forward, not today.
So let me bring in someone